During the 2006 special session that was in response to the West Orange Cove Supreme Court decision, and when they did the compressions and they came up with a new funding system, there were some districts that whenever they took out some of the excesses, ended up with less money when they went through the formula system. In fact, in one year, 2007-8, every district had less money than what they had before because of some things, recessionary things that were going on at that time. But what they did was they said, we don't want anybody to lose money. So we're going to guarantee the funding level that we no longer think is cost-based, but we're going to guarantee that. And they came up with a target revenue plan, and ASATR, Additional State Aid for Tax Reduction, is part of that. So target revenue, a temporary hold harmless, it's based on 3 different scenarios from 2005, 6, 6, 7. It's already been increased one time. And so whenever you calculate this funding level and target revenue, or what you get through the cost-based formula system, if your target revenue is higher than what you get through the formulas, and every district has a target revenue level, and every district has a cost-based formula funding level for Tier 1, you get the higher of the two. Most districts are in the system because their target revenue is low to start with, and we've raised the basic allotment a bit since this all started. But there are still some districts that have are funded through target revenue, and that's this excess funding that we've talked about. In 2011, what we had was a recession, and the state came in and they reduced funding. And one of the ways that they reduced funding was they multiplied the target revenue adjustment factor. They created a target revenue adjustment factor, and this is the percent for 2012-13, and you multiplied whatever your target revenue amount was by this amount. And so target revenue was brought down, and it was used to help offset the budget deficit that was in place at that particular time. This last year, 2013, they raised it. This is for last year and this year, and so it's a little bit higher TRAF, and so they keep a little bit more of that target revenue, but it's a marginal amount. So now let's calculate target revenue now that we have some history. Okay, here's how you calculate it. Now, first of all, you've got your revenue per WATA in 2009-10, and that includes the $120 that you added to it. And we're going to assume that it's that amount of money because you'll see in a minute the numbers changed to something easy to work with. So I selected that number. All right, you apply this adjustment that's set for this year, which is 92.63%. And that reduces your target revenue down to $6,000 in this illustration. Now, you take your current year WATA, which we're going to estimate to be $5,000, just choosing a number at random. So if this is your guaranteed funding level, your target revenue funding level, you can multiply that number by your WATA, and this is your amount, that's your base target revenue. That's what you're guaranteed to get no matter what your Tier 1 funding level may have calculated out to be using the formulas. Now you got to apply some adjustments. In this case, we're going to take the adjustment for changes in tuition, NEFA, transportation allotment, and let's just assume that added $100,000 to that $30 million level. And then you also have a thing that's been in place for a long time. This is another example of outside the system funding where they had some money left over, and they said, well, we're going to give you a certain amount of money, in this case $23.63 per employee. It's educator salary, and so everybody gets that money. So a district that's taxing at 80 cents gets the same amount of money as a district that's forced all the way to $1.17 and is funded at that $1.17 at a lower level. So that's another place you could get money to put back into the system, depending on how the court case turns out. So we're going to assume that that's $100,000 as well that you got after you applied the TRAF to that money, that you got that extra money, because it's on top. It's outside the system. So this is your adjusted minimum revenue. Now, from what we have here, we've assumed that Tier 1 state aid is $10 million. We're just making that number up. And we're assuming the M&O collections are $20 million. And your recapture, because this was a property wealthy district, is $5 million recaptured. So 10 plus 20 is 30. Take away $5 million, and you get $25 million as what you get through the formulas, applying all of those things together the way that we've learned through the prior sessions. But if you take that target revenue collection calculation from the prior slide, that $30,200,000, here's what you get through the formulas. This is what you get from target revenue. Then you get an additional $5,200,000 out of state aid. And that funding is called additional state aid for tax reduction, or ASATR. And that's extra money. And it's something that's very disequalizing, and it's not related to cost. It's related to where you happen to be at a snapshot in 2005-06. So if your collections had happened to go up dramatically that year because somebody paid delinquent taxes, then you have a high target revenue amount and you get extra money, and have for nearly a decade now. It's totally without regard to what costs are. And that's it.